Hey everyone, and welcome back to the channel. Moderna just dropped its Q3 2025 earnings report, and the market's reaction has been seriously positive. The stock popped over 7% in pre-market trading. But here's the million-dollar question. Was this just a one-time beat, or is it a sign of a genuine turnaround for this biotech giant? In this video, we're diving deep into the numbers, the strategy, and what it all means for investors. Let's break it down. Moderna Inc., ticker MMRNA, is a pioneering biotechnology company founded in 2010 and headquartered in Cambridge, Massachusetts, which is focused on the discovery and development of therapeutics and vaccines based on messenger RNA, mRNA, technology. The company's platform centers on using mRNA to instruct cells in the human body to produce their own proteins to prevent or fight diseases. Prior to 2020, Moderna was primarily a clinical stage company, but it achieved global prominence with the rapid development and authorization of one of the first effective COVID-19 vaccines, which became a cornerstone of the pandemic response and its primary source of revenue. Beyond its COVID-19 vaccine, Moderna's robust pipeline includes potential mRNA medicines for a wide range of diseases, including infectious diseases like influenza and RSV, oncology, cardiovascular diseases, and autoimmune disorders, positioning it as a leader in the field of genetic medicine. First, let's look at the headline figures. On the surface, it's a mixed bag. Revenue came in at $1.02 billion. Now, that's down a sharp 45% compared to this time last year, which reflects the challenging post-pandemic environment for COVID vaccine sales. However, and this is a big however, it crushed analyst expectations, which were sitting around $910 million. So, while the year-over-year trend is down, they're outperforming in a declining market. The real star of the show was the earnings per share, or EPS. They reported a loss of minus $0.51 per share, which is far, far better than the whopping minus $2.05 loss that Wall Street was fearing.
So the bottom line is they're losing less money than anyone thought. That's a major earnings surprise and the first big clue to the stock's positive reaction. Okay, so how did they pull this off? It all comes down to two things: defensive strength and offensive cost-cutting. On the defensive side, look at their COVID vaccine business. U.S. sales were $782 million, beating estimates. Even more impressive, they maintained a 42% market share in the U.S., even as the overall vaccination rate fell by 30%. That shows their product is still a leader. But the real story here is cost discipline. Moderna is getting lean and mean. They slashed their combined cost of sales, R&D, and SG&A expenses by a massive 34% compared to Q3 2024. Management was very clear about their goal, to reach cash break-even by 2028. They've tightened their spending, are streamlining clinical trials, and as a result, they've increased their year-end cash guidance. They now expect to have between $6.5 and $7 billion in cash on hand, up from previous estimates. For a growth biotech, a strong cash pile is like rocket fuel for the future. This earnings report paints a picture of a company in a crucial transition. Moderna is successfully navigating the decline of its pandemic-era windfall by battening down the hatches and managing what it can control, its spending. Let's look at the reasons for optimism. Despite the negative headlines, Moderna has several strong arguments in its favor. 1. An expanding pipeline. Moderna isn't just a one-trick pony. They're aggressively moving beyond COVID. They've secured approvals for RSV and CMV vaccines, and their pipeline is packed with promising candidates in oncology and rare diseases. This diversification is crucial for building new, sustainable revenue streams. 2. Financial fortitude and discipline. The company isn't running on fumes. It's sitting on a massive war chest of over $6.6 billion in cash and investments. This gives them the financial firepower to fund R&D for years. Couple that with aggressive cost-cutting, and they're on a clear path to aim for cash break-even by 2028. 3. potential undervaluation. This is the big one for many analysts. While the stock trades around $25, the average analyst price target is often above $200. That's a massive gap, suggesting that the market is heavily discounting Moderna's future potential. If just one or two of their new pipeline hits succeed, the stock could see significant appreciation.
Now, let's address the elephant in the room. The challenges are very real, and they're the reason for the stock's depressed price. 1. The post-pandemic cliff. COVID vaccine sales have fallen off a cliff, declining around 35 to 45% year over year. This has put immense pressure on their top-line revenue and is the core of their current financial story. 2. Pipeline setbacks. The road to diversification is paved with failures. Recent late-stage trial setbacks, particularly for their CMV vaccine, have been a major blow. These failures remove near-term growth catalysts and raise valid questions about the success rate of their other candidates. 3. Fierce competition and volatility. The vaccine and therapeutic space is a battlefield. Moderna faces intense competition on all fronts. This, combined with the uncertainty, has led to extreme stock volatility, with shares significantly underperforming the broader market. Investors are clearly skeptical about their transition. The verdict is that Moderna is the definition of a high-risk, high-reward investment. You're betting on the future success of their innovative mRNA platform beyond COVID. As of November 2025, the overall picture from Wall Street is one of caution. The consensus rating for Moderna isn't a buy or a sell. It's a solid hold. Let's look at the numbers. Out of 21 major research firms covering the stock, the vast majority, 12 to be exact, are telling investors to hold. Only 3 are giving it a firm buy rating, while 5 believe it's time to sell. This split tells us that analysts are far from reaching a unanimous verdict. Now, here's the glimmer of optimism. The consensus price target for Moderna sits near $39.63. Given that the stock is currently trading significantly lower, this implies a substantial upside potential on paper. But why is there such a wide gap between the current price and the target? The answer lies in the extreme disagreement among the analysts themselves.
On the bullish side, firms like UBS and Argus Research see a path forward, with price targets reaching as high as $70 in recent months. They're likely betting on Moderna's promising pipeline beyond COVID-19. But on the other side, the bears are vocal. JP Morgan rates it underweight, and Leerink Partners has a stunningly low price target of just $15. This incredible range from $15 to $70 shows just how polarized the expert view on Moderna really is. So, how do we make sense of all this? Analysts are essentially weighing two sides of the same coin. On the positive side, they acknowledge Moderna's strong cost discipline and genuine progress in its drug pipeline. The company is working hard to prove it's more than just a COVID vaccine story. However, these positives are balanced against serious concerns: declining revenues as vaccine demand falls, and the intense competitive and regulatory challenges that every biotech company faces. In conclusion, the hold rating isn't a sign of a bad company, but of a complex risk-reward profile. For most investors, analysts suggest it's not the time to make a big bet, but it's also not the time to completely look away. It's a wait-and-see story, where the key will be Moderna's execution in bringing its next-generation treatments to market. What's your take on Moderna? Are you bullish on its pipeline, or do the risks outweigh the potential? Let us know in the comments below. Don't forget to like and subscribe for more unbiased analyst deep dives. Thanks for watching.